Welcome to the Passive Investing Masterclass. I'm your host, Whitney Elkins-Hutten, Director of Investor Education here at PassiveInvesting.com. And I'm curious to know, have you considered investing in debt funds, but just don't know which debt fund is good, which one are like worth investing in, maybe not even worth your time, maybe they're too risky, or ones that are just like, wow, this is just as much risk as if I were going into an equity deal. Here's the question. How do you know? We are going to tackle that question into today's session. But before we jump in, if this is the first time you and I are meeting, we do the show live every Tuesday to help you learn the ins and outs of passive investing. So maybe you tried investing in a passive deal before, but just felt overwhelmed, or you actually made an investment and then you realized it didn't align with your goals and didn't protect your capital, or you just are like sitting on the sidelines, you're a seasoned investor, you're sitting in cash, and you're just really uncertain of your next move. You're just not sure what to do in today's market. We are going to help you break through these obstacles today because you're not alone. We are going to tackle how to simplify the decision to invest in debt funds. And again, my name is Whitney Elkins-Hutten. This is what I love doing here, spending my time here with you to help you learn the ins and outs of passive investing as the Director of Investor Education here. But also, I've documented my passive investing journey and active investing journey in my book, Money for Tomorrow. That's available on BiggerPockets and Amazon.com. But really, what I am here to do is to help you learn how I have scaled a portfolio that allows me 100% choice and freedom on how I spend my time. And really, it's to do this, spend time with my crazy crew here that, if you're watching via video, and spend time here with you, helping you learn the ins and outs. Now, we can actually help you do that here at PassiveInvesting.com, whether you want to be invested in equity deals or if you want to match yourself with debt deals, maybe add those to your portfolio, because right now we're going to talk about is one of the best times in the market cycle to do that. Or if you just are wanting to kind of step away from taking the equity risk right now, but still want the stable cash flow returns and possibly even compound it like an equity deal, we're going to show you how to do that today. But in order for you to get access to those open deals, all that education, make sure to join the Passive Investing Club. There you get a one-on-one call with me. We can discuss all your investing goals and really help you create that alignment towards that next step that you need to in today's market cycle. You also get exclusive access to our open deals and, of course, all the wonderful education that we put out there. You can either visit passiveinvestingwithwhitney.com or scan the QR code on the screen. All right. Now, we're going to talk numbers today like we do most sessions, but I just got to put it out there. This is all information. It's education. So we're not legal experts, tax experts, or fiduciary experts, financial experts. So make sure you take all this information back to your investing team before making any investment decisions. So we open today's show with a question. Have you considered investing in debt deals? Have you considered adding this layer to your portfolio? And why is the right time for you to do that? Well, because the market has created the opportunity. And that opportunity to add a debt layer into your portfolio has existed for about that past 18 to 24 months. So this isn't new. But I think a lot of investors, and maybe you, I know me as well, we're kind of sitting here waiting, holding our breath, going, is the Fed going to lower interest rates? Is inflation really going to stay closer to that 2%? What's going to happen with tariffs? If all of this starts aligning in the marketplace, are the banks going to start really lending again? And are we going to see like a restart with equity? Okay, maybe you're just nervous to make those decisions and invest in something right now, or you're just sitting here waiting, going, wow, when's the right time? But here's the thing, right now, the uncertainty still persists. Interest rates still remain high. Equity deals are starting to come back online. However, they kind of come with an asterisk. They still don't have much cash flow to them. So what are you to do, especially if you want cash flow? Your capital does not have to sit idle on the sidelines. You can actually invest into a structured investment right now that will give you control, that will give you the optionality, and more importantly, that monthly income that we all have grown accustomed to. All right. So what is that investment? Well, I already kind of tipped my cards at the beginning of the show. It's, have you kind of solved for that layer of, the portfolio of debt funds. Now, I have a coaching client that I've been working with. She's a physician, and she is so driven to get her next equity deal, scaling multifamilies, also, into self-storage, express car washes. She was like, you know what, Whitney? It just dawned on me, all what you've been trying to tell us for the past year is that I don't need more write-offs. I need optionality. What I want is to be able to have the opportunity to step away from my job on my terms, which means I need cash flow coming in. It's great that I've got these equity investments. It's great that I've got the tax benefits coming in from them, but I actually need to start cranking up that cash flow layer to where I get that optionality. And whenever that realization finally landed for her that she needed income producing assets in her portfolio, that could actually weather the market, volatility that's happening right now, it really blew the doors off her portfolio. So let's talk about this. What is a debt fund? Okay. So a debt fund is a real estate, a pool of investments basically into the debt side of the investment, not the equity side of the investment. And the actual fund lends to real estate operators that are actually writing notes or deeds of trust onto real estate property. Okay, so essentially you're acting like the bank. Okay, you're actually secured by the property itself. So you're standing there first in line if for whatever reason that borrower cannot pay the bills, you actually can get to take the property back. Now, that's if you're writing your own individual notes. The debt fund itself, if you're going into this pooled investment that holds multiple notes, that fund gets to take repossession of the property. So your priority payment in case of default deficiency, okay, you earn interest income like the bank because you are the bank. Okay, you don't have any property management headaches. You have no tenants to, issues to handle, no tenants, termites, trash, none of that. Okay, but you also have no equity ownership complications. Now, for some people that are watching the webinar, they might be like, ooh, I actually want the equity. And we're going to show you how to leverage debt like equity here in a minute. But for others that are just going, wow, I'm over allocated on the equity side of things, and I'm waiting for all of that to kind of iron itself out over the next couple of years. Let me start getting some cash flow coming in. This is the perfect opportunity to restructure your portfolio and get that going. So what do we know? Now that we understand what a debt fund is, what do we need to know in order to make this investment safely? Well, first of all, we need to understand the capital stack, which are the different layers of money that can go into a deal. So most investors, myself included, we, up until like 2 or 3 years ago, the common equity class could get us cash flow, equity growth, tax benefits, everything rolled up into one. Okay, but you're also taking the highest risk in order to get the highest reward. All right, this debt funds typically play in what we call below the line. So they're going to be more the bank side of things. They're actually an expense to the deal. Okay, the borrower actually has to pay this money back, either the senior debt position, which is like the bank. If you own your own primary residence, it would be whoever owns the first position note in your property, or they play more in the mezzanine type debt positions, which is like a home equity line of credit or a home equity loan. They're more the second tier money. Okay. Now, the debt is the foundation of the capital stack. Senior debt gets paid first. Okay. So say we had to take back the property or sell the property. The senior debt gets paid off first, then the mezzanine debt. Then if there's any left over, the preferred equity tier gets paid, and then the common equity class gets paid. Okay. It's very important in any passive deal, or actually any deal, any real estate deal, you know what layer of the capital stack you're going into. That will help determine your risk profile for the deal. Now let's do a comparison between equity and debt so we can actually delineate this a little bit clearer. So equity, again, like we said, is the highest, highest risk, but also the highest reward. You're the last to get paid though, if a deal goes sideways or south. Whereas debt, if it's structured properly in your true first position, you're going to be really low, way lower in the capital stack, and your risk is pretty low because there has to be a lot of equity loss before you don't get paid. Cash flow equity deals variable to none right now in today's market. With debt, it still is getting paid monthly, depending on how it's structured, and you might be able to compound it. Liquidity, equity deals, highly illiquid. Okay, so you're in the deal 3, 5, 7, maybe even 10 years. I always help my investors orient whatever you see on the PPM, add +2, and you might be close to what the actual timeline is. Debt deals, though, especially when we go into a debt fund structure, these type of debt funds that we're talking about today are going to be, very liquid, meaning we might have a lockup period associated with it. We're going to show you how to avoid the lockup period today. But generally, you can call your money due, and within 90 days or maybe even less than 30 days, you can get your money back. So it's pretty liquid. Timeline, again, along with that illiquidity factor, you're 3 to 7 years plus into a deal, and you're part of the partnership. So it's not like you get to vote on when to exit the deal. A debt fund, some debt funds might have a 3-month to a 36-month lockup on them. But you get to choose that up front, and you know how long your capital is being locked up for. And a return potential. Okay, equity deals, my mind, if I'm not realistically going to make 1.7x or more on my money, I'm not even looking at the equity deal, really. Okay, because it's a lot of risk for me to get it. Whereas I could go into a debt deal and allow it to compound and properly achieve that equity-like return. But keep in mind here, I'm not saying invest in equity or invest in debt over equity. That's not what I'm saying. Both have a position in your portfolio, but what is the market giving us right now? That's the true question. So again, making sure that when you look at your portfolio, you're looking at it as if it were a stool. We've got 3 legs, right? Most people are just if we looked at your portfolio and you were truly tracking it, I would imagine you would see that a lot of your portfolio, for most people watching this video, are very heavy on equity. Okay. It was like the charm deal to go into for like the past 5 to 7 years. But debt has its place in it. Okay, it's a leg. It's going to help smooth that ride, that volatility ride, create predictable cash flow for us. And then we also need that liquidity leg. Now, liquidity means that we could actually have cash in the bank. We could have cash accessible in a cash flow life insurance policy, or you have a series of debt investments that are highly liquid that you can get at any time. That helps create liquidity as well. So you need all 3 of those legs. Now, understanding when to go into these legs of the stool is kind of the next level of play that most limited partners need to learn about, is how to time the market. Now, timing the market is really, for me, and how I play the investing game right now, is really it depends on when you start investing in passive deals. That's your biggest risk in the market. But over time, if you're creating a balanced portfolio, one that again has all three of those legs, to the portfolio, the debt, the equity, and the liquidity, you can now start writing out market cycles a little bit better. So your largest risk is going to be when you enter this particular investment. So first, we need to understand the market cycle. We talk about this a lot on the podcast here, but phase one is recovery. We're coming out of a recession. Banks are starting to loosen their lending guidelines, but there's no new construction yet. So you still get a lot of absorption. Rents start increasing on, say, like multifamily or self-storage. Then you go into expansion. Okay, that's when the banks finally come off the sideline and they start investing money into deals. We get the cranes in the air, lots of booming going on. And then at some point in time, we get that tilt. All right, there's too much going on in the market. We get a lot of hyper supply. So we start seeing increasing in vacancy, still a lot of new construction, but our supply demand metrics get out of balance. And then we start tilting down into increasing vacancy, more completions that are happening. We start hitting that recession part of the market. So that's number one. Where are you in the market? Most parts of the United States right now, August 2025, we're in, either hitting that lower part of the hypersupply into the recessionary part of the markets. There's a little bit several areas in the United States that might be slipping through into recovery right now, but we're right into this trough. Depending on where you live and where you're investing, which part of the trough are you in? Are you still on the way down or are you coming out? Okay, that's going to be a very local question to ask. All right, let me move to the other part of the cycle that we got to understand, which is understanding the credit cycle. How does that lay on top of everything? So when we have this expansion, the run up of, into expansion and even into hypersupply, there's a lot of money floating around. Banks are lending. Okay. There's a lot of private lenders too. But when we start hitting into that extreme hypersupply into the recession, we start seeing the pullback. Less credit is available. Okay, banks start getting nervous, they start moving to the sidelines, but this is a unique opportunity for you as a private lender to step in and start solving the bank's return. When we do this in the right parts of the market cycle, we get to shift and generate income. So the income might not be coming from our equity investments, but then we can pivot and start absorbing the income from our debt-like investments. It allows us to maintain flexibility, okay? We can keep shorter investment horizon timelines within our portfolio, allowing us to either stay invested and reap the return or be nimble as other deals that we really want to go into come online. But most importantly, when you add a debt layer, intentionally add it into your portfolio and hold on to that layer through all parts of the market cycle, you're now positioning your portfolio for future resiliency. So let's talk about that. Okay, what do you need to know as an investor to make sure that you're going into good debt investments? I'm going to clue you in. Not all, just because somebody says, "Hey, I have a debt fund," an operator, they have a debt fund, doesn't mean it's safe. And I remember standing at a very popular passive investing conference in May. And I asked the question to the group, hey, when you hear the word debt fund, what do you think? Is it a safe investment? Is it not? And it was amazing that a lot of sophisticated investors in the group assumed that debt fund just meant it was super conservative. And they kind of stayed away from it because it was so conservative. But that's not the case. Let me give you a framework to kind of think through how conservative or aggressive that a debt fund might be. Well, first you have to take into account the asset type. Is it going into residential, type, primary mortgages, fix and flips, really the residential, single family, 1 to 4 unit, the roof that everybody needs over their head? Or is it going into commercial, multifamily, self-storage, office, retail, okay? Residential is necessary. We are undersupplied on housing. Commercial, in some aspects, we might actually be oversupplied. Okay, so you're stepping up in your risk. Maybe is it the debt fund holding land or raw land? Where is it in its entitlement cycle? Is it shovel ready, ready to be ground up developed? We've got the plans all ready to go, all the entitlements there, all the utilities laid. Or is it still going through city review, or is it just raw land? And, a lot of work needs to be done and it may not work. Okay. Again, the asset type is going to help us understand the risk of that debt fund. What phase of development is the asset in the debt fund? Is the debt fund lending on stabilized assets? Okay, maybe some ones that need a little bit of love, but not a whole lot of love. Is it lending on severely distressed assets? Or is it lending on ground up development? Again, each of those are going to have its own risk profile. What position of loans does the debt fund make? Is it senior debt, that first position lien, where you are, if something goes wrong with the asset, you're standing first in line ready to take that asset back? Or are you in a secondary position, like a mezzanine debt position? Or are you not actually lending on the property itself? Rather, you're lending on the construction piece of the property. Okay, maybe you're not even tied to the actual property itself. And then how is it structured? Okay, are you investing in individual notes? And that takes a lot of capital to do, and it reduces your diversification. Are you going into a private note fund where you can get diversified instantly over multiple borrowers, markets, and deals? Or are you going into a crowdfunding type structure where essentially we've shifted it to where you give up the control of what asset is actually being lent on, and it's more of like a capital aggregation structure. All right, so we want to think through these 4 areas because the closer we can stay to the top bullet in each one of these categories, or maybe even the second bullet in each of these categories, is going to help us de-risk or understand how conservative that investment is versus how risky it is. So where do things go wrong? Okay, if somebody was like, okay, great, Whitney, I saw that slide, I took a screenshot, I'm going to add that to my due diligence, but tell me the big areas where, what are the big red flags at debt funds? Well, the first one is weak underwriting standards. And I've talked to many debt fund lender, and they all say, yes, we write on the asset, but it's really the borrower. Okay. We want to understand who we are lending money to and what their background and track record is. Okay, so we got indicators of borrower scrutiny or even the property valuation. Either one can get you in trouble, but I look at the borrower first. Okay, where else can debt funds go wrong? Well, you got to understand which position you're investing in a debt fund. The further away you get to from being that primary lender, if you get into junior lien positions, those subordinate positions are far more risky, right? Now, remember, we're adding this piece into our portfolio to stabilize cash flow, but not necessarily take on much more risk. We've got the risk. The risk is in the equity deals. Why do we have to take more risk in our debt deals? Okay. And then a lack of a recovery plan. What are all the different exits that borrower could potentially take to make that note or that loan whole? Okay, so we want to make sure that the borrower's got a plan A, B, and then maybe you even have a couple backup plans yourself, or the debt fund has a couple backup plans itself in order to make the fund hold. So really, there's not bad structuring of a debt fund is what makes bad outcomes. So we want to make sure these are taken care of at the top. So how do we understand the different structuring here? Okay, if we're going to vet the debt fund and make sure it's properly structured, we want to understand the people running the fund, the processes they're following, and the projections. Now, this is very much like how you've already vetted possibly an equity deal that you've been into. Okay, so we're going to evaluate the operator, the people running the fund, but we also want to evaluate the people lending the money. Okay, we got 2 operators here, the one raising the money and the one deploying the capital. We want to track back expertise, their alignment with investor interest. Number two, we want to understand their processes. Okay, remember, we talked about all the different ways that a debt fund could go awry. And so it's either the first one is we didn't vet the borrower well enough, or we didn't vet the property well enough. So we want to understand how they're qualifying the borrower. How are they evaluating the property? What methodology are they using? How are they actually servicing the loan and keeping track on whether the loan is going to be fulfilled, right? You want that operator should know before the borrower knows that they're in trouble. And then how are they going to handle any sort of defaults? Okay, it's unrealistic for any investor to think that a note will never be, there will never be a default. Okay, we want to know how that debt fund operator is making sure to keep the default rate as low as possible. And then protections. We're going to get into this a little bit heavier in the next couple slides, but what are your safeguards? What position are you in the loan? What's the loan to value on the property? Is the borrower giving any sort of guarantee should the property go into default? And then what are those exit options? So this is a great screen, especially if you're watching on video. If you don't have a due diligence process in order to evaluate a debt fund to understand if it falls in the good, the bad, or the ugly category, this is a great screen to kind of take a screenshot. Because again, you're going to make sure you're asking questions on where are you in the capital stack? Are you in first position lien, kind of like what we do here at passiveinvesting.com? Or are you in a fund that's mixed, and some might be first position, some junior lien, some ground up construction, some construction debt, right? What asset class are you going into? Are you going into a very focused fund that's residentially focused, or are you going into a fund that's mixed? Okay, there's no right or wrong way to do this. It's how much risk are you willing to take as an investor, right? How diversified are you? Are you diversified across hundreds of loans, multiple borrowers, multiple markets, multiple deals? Or are you just diversified across a handful of loans, maybe like 40, 50 loans in a singular market, with a few borrowers and maybe just one or two asset classes? Distribution, okay? How is the money coming to you? Is it coming to you monthly? Okay, are you able to compound it or not? Default rate. Are you with an operator that is intentionally trying to keep the default rate as close to zero as possible, like we do? Or are you with a borrower, or excuse me, an operator that's playing more of a numbers game? Okay, they're okay with the industry standard of 1 to 3%. What are the lockup periods? Okay, are you in a fund that will allow you that flexibility that we all seek, or is your money going to be locked up for 6 months to 3 years? Is the fund levered at all? Is the operator taking your money to the bank to get a loan in order to lend out more money? So just think about it. If you are investing in a first position lien fund that has a line of credit on it, are you really in first position anymore? Probably not. The bank gets paid first. The bank gets paid first, then you. All right. So I know a lot of people are probably listening to this and we're like, tell me more about your PIK real estate debt fund. Why is it so important that that debt fund right now fits the market, the moment that we're in? Well, as you can probably imagine, when we are looking to inject this debt fund layer into our portfolio, we want to start with smoothing out cash flow, smoothing out volatility. So I encourage people to look at a debt fund that's in first lien position, has already that built-in diversification of hundreds of loans across multiple markets and borrowers, really a fund that puts you in a true preferred return position, okay? Meaning you as a limited partner, you're getting paid your preferred return before any expenses of the fund. That means you have no line of credit or debt on the fund, okay? Look at something that gives you that flexibility. Monthly income allows you to compound. And again, has great liquidity provisions. We can always get riskier with our debt positions, okay? That is totally fine. But let's start with this leg of the stool first. So this is what sets our fund apart. As far as, I know a lot of people might be going, well, tell me more about the fund. Well, here you go. We primarily lend in North Carolina, South Carolina, even a little bit into the Atlanta, Georgia area. Short-term, first position, fix and flip loans. We've done over almost 2,200 loans, about 470 active in the portfolio right now, that are 6 to 9 months long. Okay, so we can be very nimble with the market. Our loan to value is typically around that 60-65%. Our repeat borrower track record is over 85%, meaning we have a long-standing history with our borrowers of the fund, and we know how they're going to perform. And our deficiencies are targeted. Right now, we're at 0.15% default rate. Now, remember, industry standard when you look at debt funds is 1 to 3%. So we're 10 times less than the industry standard. And then we have zero leverage on funds. Now, the big pushback that I get, people are like, why do I even go into a debt fund? I want to compound like equity. I want to grow like equity. Well, how do we do that with a debt fund? Because I promised you at the beginning of today's conversation, we could do that. And part of it is you can compound your cash flow. If you don't need it, allow it to compound and grow. Okay. You can get a 17% effective annual rate of return if you allowed it to compound with taking very little risk. Now, I'm going to jump ahead here because another question that I often get is like, what about the tax benefits? Remember, Whitney, I went into those equity deals because I wanted to have tax-free income. Okay, so yes, you don't get depreciation, but you get some trade-offs here. You don't have to deal with tenants, termites, trash, capital calls. Okay, so you get consistent cash flow, and you can strategically use other funds to go into tax advantage assets like your cost segregation, heavy multifamily deals, opportunity zones, oil and gas, conservative easements, or you can put your debt fund investments into a tax deferred vehicle or a tax advantage vehicle like a Roth IRA. That's one of my favorite like little hacks. So really, it's not an either or type of decision we're making here. We're looking to create a comprehensive portfolio where our strategy is across the portfolio, not deal by deal. All right. So again, remember investing in a debt fund, it can be a bridge strategy for you to create this cash flow in your portfolio to smooth the ride, especially if you're sitting on cash, if you're wanting income without the high risk, and if you're still waiting for opportunities. This can be an amazing bridge strategy. Now, if you're here live, I encourage you to put your questions into the chat box, into the Q&A box. Let's dissect what we covered today, get all your questions answered. If you are listening to this on your favorite podcast player of choice, be sure to rewind and make sure that you've digested all the information, understood how this fits into your strategy. If not, join us at passiveinvestingwithwhitney.com. There we will get all your questions answered. Don't go anywhere. Let's start the Ask Me Anything part of your show.